Want to add a blue chip dividend king to your portfolio? Does more than 60 consecutive years of dividend increases sound good to you? Looking for a high quality stock on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a large industrial firm that touches nearly every aspect of society. All of that stuff around you, all of that stuff you use, yeah, that has to be manufactured. And there are a few large global manufacturers that are crucial to getting all of that stuff actually made. As long as society continues to, use stuff, these manufacturers should continue to prosper. And that should translate to higher profits and higher dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of 3M Company, which appear to be trading at a significant discount today. 3M Company, stock ticker MMM, is a diversified global manufacturing conglomerate. Founded in 1902, they're a $107 billion by market cap industrial behemoth that employs 95,000 people. 3M operates across 4 business segments: safety and industrial, 34% of fiscal year 2020 sales, transportation and electronics, 26%, healthcare, 25%, consumer, 16%. Corporate and unallocated accounted for the remainder. The Americas accounted for 51% of fiscal year 2020 revenue, 30% Asia Pacific, and 19% Europe, Middle East, and Africa. The company focuses on applying science across 12 different areas of expertise: automotive, design and construction, manufacturing, commercial solutions, electronics, mining, oil and gas, communications, energy, safety, consumer, healthcare, and transportation. Their products are used in various end applications, including appliances, packaging, aerospace, electronics, construction, surgical supplies, telecommunications networks, and renewable energy. 3M has numerous brands that convey quality and consistency both on the consumer and industrial side. Some of their brands are Scotch, Scotchgard, Post-it, Scotch-Brite, Ace, and the eponymous 3M. This is a very large and diversified global industrial company with incredible breadth, which touches almost every facet of life across the world. As society prospers, so should 3M. There's almost no future in which 3M isn't prospering. As long as society continues to advance, so should 3M. This augurs well for their ability to increase their profit and their dividend over the long run. Already, 3M is a legend in this respect. They've increased their dividend for 63 consecutive years. That's one of the longest such track records in existence, spanning wars, recessions, and even the pandemic. This easily qualifies them to be a dividend aristocrat. It also crowns them a dividend king. Dividend kings are stocks that have increased their dividends for 50 or more consecutive years. Their double-digit 10-year dividend growth rate of 10.8% is also impressive, although recent dividend increases have been rather modest. While dividend growth of late has slowed, the current yield has risen to 3.2%. So it's a dynamic where you're getting more yield in lieu of the growth. That yield, by the way, is more than twice as high as what the broader market offers. It's also 40 basis points higher than the stock's own 5-year average yield. And with the payout ratio at only 58.6%, this is a well-covered dividend. Looking at business growth, 3M increased its revenue from $29.611 billion in fiscal year 2011 to $32.184 billion in fiscal year 2020. That's a compound annual growth rate of 0.93%. Meanwhile, earnings per share moved up from $5.96 to $9.25 over this period, which is a compound annual growth rate of 5.01%. Now, 5% isn't lighting the world on fire. However, I actually see this as rather solid. The ending year of this period, 2020, involved a global pandemic and worldwide economic shutdowns. A lot of excess bottom line growth came about from buybacks, with 3M reducing its outstanding share count by 19% over the last decade. Looking forward, CFRA believes that 3M will compound its earnings per share at an annual rate of 11% over the next 3 years. That would represent a nice acceleration of bottom line growth relative to what 3M has produced over the last 10 years. Somewhat interesting is CFRA's take on 3M's asymmetric risk-reward profile. They say this, and I quote, "A diverse product and geographic base allows 3M to outperform the economy in periods of economic weakness in our view. 2020 earnings per share was down just 2% versus 2019, while the S&P 500s fell 13%, unquote. And then there's this, again, I quote, "We also see 3M outperforming the broader economy as vaccinations quell the pandemic and drive reopening, thanks to high exposure to the residential construction boom and rebounding end markets like autos, manufacturing, and general medical supplies," unquote. Less downside and more upside. That's the best of both worlds. If 3M is able to perform as CFRA is forecasting, that would set them up for at least mid-single-digit dividend growth for the foreseeable future, and that's the base case I'm working with. Moving over to the balance sheet, 3M's rock-solid financial position is another reason to like the business. They have a long-term debt-to-equity ratio of 1.4. While that looks high at first glance, it's largely because of treasury stock relating to the buybacks artificially weighing on shareholders' equity. The interest coverage ratio of over 13 tells the better story, which is one of no issues whatsoever with the debt load or the servicing of it. Profitability is consistent and robust. Over the last 5 years, the firm has averaged annual net margin of 15.89% and annual return on equity of 45.8%. 3M is a blue chip dividend king with one of the most reliable dividends you'll find, and they could be on the cusp of a growth renaissance. And the company is protected by durable competitive advantages like economies of scale, brands, patents, IP, and a large R&D platform for innovation. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. I see litigation as a bigger risk for 3M in particular compared to regulation and competition. As diversified as 3M is, a global recession would impact them due to exposure to cyclical end markets. Their 2019 $6.7 billion acquisition of medical products maker Acelity Inc., which is 3M's largest acquisition ever, has integration and execution risks. This acquisition reduced the company's flexibility and balance sheet strength. It's still a question as to whether or not this will be an accretive acquisition, and the R&D spending is high and must be rationalized through new products. With these risks known, I still believe that 3M could be a great long-term investment for dividend growth investors. The current valuation only makes me more enthusiastic. The price-earnings ratio is sitting at 18.3, which is quite a bit lower than the broader market's earnings multiple. It's also significantly lower than the stock's own 5-year average price-earnings ratio of 22.5. The price-to-cash flow ratio of 12.7 is also well off of its own 5-year average of 16.7. That's despite the fact that there could be a near-term growth acceleration setting upon 3M. The stock arguably deserves a higher than average multiple, yet it's getting a lower than average multiple, and the yield, as noted earlier, is materially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate can look aggressive or conservative depending on your perspective. Against recent dividend increases and the 10-year earnings per share growth rate, it looks aggressive. On the other hand, it looks conservative against the 10-year demonstrated dividend growth rate and CFRA's near-term earnings per share growth forecast. I'm basically splitting the difference here, assuming that dividend growth going forward will be better than it's recently been, but not as high as the 10-year dividend growth rate. The payout ratio is moderate, and earnings per share growth is expected to be strong over the next few years. I think 3M is fully capable of delivering mid-single-digit dividend growth from here. The dividend discount model analysis gives me a fair value of $211.15. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates 3M as a 3-star stock with a fair value estimate of $195. CFRA rates 3M as a 4-star buy with a 12-month target price of $224. I came out roughly in the middle here. Averaging the three numbers out gives us a final valuation of $210.05, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. 3M Company is a blue chip dividend king with incredible scale, diversification, and breadth. And their future could look even better than their past, which is already legendary. With a market-beating yield, more than 60 consecutive years of dividend increases, double-digit long-term dividend growth, a moderate payout ratio, and the potential that shares are 13% undervalued, this classic dividend growth stock looks on sale. And now for a special news announcement. JPMorgan Chase & Co., stock ticker JPM, is collaborating with Algonquin Power and Utilities Corp., stock ticker AQN, on the Illinois-based 108 megawatt Shady Oaks 2 wind project. This is a win-win for both companies, both of which I've highlighted on the channel before. JPMorgan Chase will purchase approximately 70% of the wind farm's energy output, which will serve as the largest contribution to date toward the bank's 100% renewable energy commitment. And Algonquin gets a fantastic long-term partner to fill reliable demand for new supply. JPM and AQN are high-quality dividend growth stocks built for the long haul. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.